I promise you I'll address the title and thumbnail of this video. It's not just for clickbait. On my X account, I said, calling the top in the stock market is not the point. I divide the stock market into 3 phases. There's a time to buy, a time to coast, and a time to profit. Now, what is it about this specific chart that is causing me to think about selling my stocks here? I'm going to explain it for you, and hopefully you can grab something out of this video. It is not for clickbait. You guys know this channel. I'm not one of these fear porn channels. I do actually have an investment thesis. When I think that it is time to buy, when I go in heavy, then I do so and I announce what I'm doing. So here's why I'm thinking about selling. Number 1 is peak rates with a peak stock market. Now, I hate really this mantra of what goes up must come down, or what goes down must come up. This is not gambler's fallacy. There are plenty of times, as I said before, the stock market made all-time highs without the stock market crashing. However, if you take a look at 2000 and you take a look at 2007 and you take a look at where we are now, let's go back in history and look at this. If you look at the year 2000, this was a stock market high at peak rates. We were in a rate hiking cycle. May 16, 2000 was the last hike of 50 basis points to 6.5% federal funds rate. If we take a look at 2007, what happened right before then? Peak rates in the middle of 2006, and the Fed held them there at, ironically, the same Fed funds rate that we're at today, 5.25%. So when I look at the stock market now in 2024, we are at a peak with peak rates. The Fed has hiked the most aggressively that they've ever hiked, and we are at around 5.25%. You can see here that the last rate hike came in July of 2023, putting us at this federal funds rate currently. Now, most of this rally was obviously the Mag 7, but the Mag 7 actually reported decent earnings and good outlook. However, how long is that going to last? Right now, it is a game of chicken between the stock market and the pressure that yields can put on the economy. And we are starting to see stocks get punished for their insane valuations. Now, I have no problem with stocks being valued so highly if there is growth to justify it, if there is guidance to justify it. But once those stocks, the minute that those stocks miss guidance, just like Palo Alto Networks did, then a stock that is valued with a 67 price earnings ratio is going to drop like a rock. And after hours, Palo Alto Networks, right after issuing weak guidance, dropped 21%. Because this environment here is not for the highly valued. People forget that we are at peak rates. Now, why is it that I can make this decision to take some profits? If you take a look at the stock market, since January 2022 to now, the stock market's only up by 3.5%. That is it. Obviously, because we had a 2-year bear market. But if you've been following this channel, what did we do during that bear market? We bought up stocks. So we are not up 3.5%. My cost basis on the SPY, on my current batch of SPY, is $370. This is the benefit of investing in bear markets. This is why I hammer it in people's heads as much as I can. People forget that the best days occur in the worst of times. The most parabolic gains don't come during bull markets. The most parabolic gains come after bear markets are established. Case in point with the S&P 500 here. This is the monthly chart. If you bought in 2022 or you bought in the correction of 2023, you saw parabolic gains. If you didn't buy anything, then between January 2022 and February 2024, you are only up 3.5%. Now, before I move on to other points, I just want to stick to the chart for one more second and talk about this phenomenon. You might be saying to yourself, Z, a minute ago, you said that the S&P 500 was only up 3.5% in the span of 2 years. We just got out of this mess. Are you telling me that there could be another drop from here? I'm going to get to that in a second as well. It's not necessarily that I think there's going to be a drop, but let me address the possible question of that phenomenon of, getting out of the mess before falling once again. We see this all the time. Between 2000 and 2007, we barely hit the peak that we did in 2000 before the market crashed 40 or 50%. If you take a look at it, if you want a closer time frame in between peaks, how about we look at what happened in 2018? If you take a look at February 2018 to September 2018, we just crawled out of a correction, barely moved a few points, and then we had an almost 20% drop. Same thing happened between 2018 and 2019. We had an almost bear market. So these things do happen. Now, do I think that we will necessarily drop from here? As I said before, 500 was my target on the SPY, or 5,000 on SPX. I've said this back in September of 2023 when I said that I was buying stocks heavily to ride it up to that 500 psychological level. I want you to take a look at what happened in the year 2004. Now, why 2004? Because we've been hearing time and time again, if we take a look at the weekly chart, that this weekly streak is one of the most most historic weekly streaks, and it is 14 out of 15 green weeks. When was the last time we saw a similar streak? It was in 2004. So let's take a look at 2004 real quick, and I want to show you what happened and the reason that this is apropos here. So in 2004, we had 9 straight green weeks. It looks actually very similar to what we see currently, but this was also a presidential election year, just like this year. And the weakness started forming in February 2004, right? This is, remember, an election year. So we really stalled between February 2004 all the way until after the election. In November, did we start a rally again? Now, I believe that something similar can happen here if it wasn't for the potential of a recession. In 2004, we had just gotten out of a recession and we didn't know that we were about to be in one in 2007. However, here we are also in an election year. And after such a streak, if the best thing in my mind, if the best case scenario is that we basically go sideways until the election, then yeah, if that is the best case scenario, of course I want to take profit. Of course I'm comfortable taking profit here. If the worst case scenario is that we get a recession mid-year and the market drops, then yes, I will be happy that I took profits. Now, obviously, we can continue rallying. If NVDA earnings come in good, we can continue rallying. But how much more juice is there? You know, once again, you can reward yourself for buying the lows. You can reward yourself for buying in a bear market by selling at the highs. Isn't that what the whole point is? Obviously, the market can continue rallying. You're only stuck here if you didn't buy, or even worse, you bought at the high. And I just want to say one thing, right? Obviously, I don't have just one portfolio where now I'm going to dump everything. This is just more of a general idea. Obviously, my sells are going to be strategic. There are certain things I might do, like deploy covered calls, for instance. I already sent out an alert for covered calls on the SPY in the options selling channel. So right here in the option selling channel, I also sold covered calls on some riskier stocks like Celsius, for instance. We bought Celsius at 49, currently trading at 64. By the way, our group is currently closed to the public. I gave everybody fair warning, at least a month of warning. We are now waitlist only. Make sure that you get your name on the waitlist below. And if you are approved, we're opening signups back again on the 26th of February for a week. It will be a week window. So make sure that if you want to get in the group, that you get in during that time. All right, back to the show. Now, reason number 2 that makes me a little bit uneasy about where the market is currently. Markets start to speculate if the next Fed move is up, not down. We are already starting to see some uncertainty about what the Fed is going to do. And remember, it was just a minute ago, it felt like it, that everyone was pricing in 4 to 5 rate cuts by 2024, by the end of 2024, which led to some of this enthusiasm. Again, yes, I know some of this enthusiasm was because of good earnings and good guidance by the Magnificent Seven, but a lot of this was also based on the expectation that the Fed was going to cut a lot sooner and more aggressively than thought. However, we are now starting to see some speculation that the Fed might actually, move upwards. Now, I don't think that's going to happen. Matter of fact, the last time that happened was in 1994, and I could tell you exactly how the market reacted to that, just in case you wanted to know. But the last time that the Fed actually raised rates, and I think it was the only time that the Fed actually raised rates unexpectedly, was April 18th, 1994, and they raised rates by 25 basis points. Now, it's important to note they were in the middle of a rate hiking cycle, so it's not like it came almost a year later, as the last rate hike now was in July 2023. This was right after they raised rates in March, but this was an unexpected emergency raise in April 1994. The S&P 500 had already started to correct before that due to the fact that rates were being raised aggressively. And actually, when the Fed decided to hike, surprisingly, that was the bottom of this 10% correction, but the market really went sideways for another couple of months or so before finally rallying towards the end of the year. Now, I personally don't think that the Fed is going to raise rates. That is just crazy. I think the last rate hike was July of 2023. They won't do it, especially in an election year. However, it is important to note that right now, it is almost a 91% chance that the Fed stays at their current rate in the March meeting. And now it is priced in at a 69% chance that the Fed remains in their May meeting as well. This was down to just 15% a month ago. Now the probability is 69% that the Fed actually stays and that we won't see the first rate hike until June of 2024. Sorry, I meant rate cut, not rate hike. But as we all know, the Fed is not just going to cut rates prematurely. They're going to cut rates when things get bad. And with much stronger data in the way of employment and in the way of inflation not budging below 3%, the Fed is going to have to keep rates rates there higher for longer. Now, I've talked about this before, but it could be a while before we get a recession. The difference between the 10-year and the 2-year, this still hasn't uninverted. And when this uninverts, let me just max it out for you, that is when we tend to see recessions. But it could be a while before this uninverts. And it's not like the second that it uninverts, we see a recession. It usually takes a few months before the uninversion and before the start of a recession. And even worse is the 10-year and 3-month, which looks like it is so far away from uninverting. This is the most inverted that it's ever been. But we need this to uninvert as well before we see a recession. So I think that the stock market can survive here for a while, especially if NVIDIA earnings are good. And I'll talk about NVIDIA in a second. But if NVIDIA earnings and guidance are good, which is a high probability, then I think the stock market can survive a bit here. We could go sideways. We could go up a bit until these things start to actually put pressure on the real economy. My point is, if I bought the dip on the S&P 500 or the QQQ, how much juice is there left to squeeze here? And at what point do I say, okay, I have to reward myself a little bit for buying the dip on those? And the time to reward myself is the time where I don't expect any more parabolic movement. Now, I'm recording this at the time before NVIDIA has reported earnings. NVIDIA hit a high of around 746. It did drop a bit pre-earnings. Now, I've seen this movie before, and I could see a point in which NVIDIA actually comes in, beats earnings, gives even better guidance than thought, and we could see one final capitulation for people trying to short this minus 4% candle here. I could see that happening. Is it going to happen? Not entirely sure, but I could see it happening. It's not out of the realm of possibility. And I also posted this on my Twitter. By the way, you need to follow me on Twitter for daily free trading and finance content, as well as on Instagram. I post valuable stuff all day. Sometimes it's not so valuable, and I'm just posting memes. But the point still stands. You need to follow me. I said yesterday that NVIDIA was more overvalued at $277 than it is at $726. How can that be? Well, if you take a look at NVIDIA at $277, look at its PE ratio. It's 144. Its earnings per share was only 192. Over the course of a year, NVIDIA's earnings grew so fast that its earnings per share jumped to 7.58, and its PE ratio was at 95. So much less than 144, still high, but much less than it was when NVIDIA was 277. And this is part of the reason why NVIDIA's stock price kept going up, because this growth was actually priced in. So what they said would happen actually started happening. Their EPS went from 1.92 all the way to 7.58. So it wasn't for nothing. Again, just like Palo Alto Networks, if NVIDIA disappoints on guidance and if it misses earnings and the stock market gets a glimpse that NVIDIA might not be able to maintain the growth that is priced into their stock price currently, then NVIDIA can see a decline from here. But I can also see NVIDIA honestly come in, meet guidance, beat earnings without a problem, and have one final capitulation for the shorts that thought this was the candle to go short. Now, one final point that's causing me a little bit of dis-ease is what is going on with the VIX. And no, it's not what your Uber driver says about the VIX. Oh, the VIX is broken ever since 0 DTE options were introduced. No. None of that. I'm talking about volatility skew. So without going into the mechanics of this, okay, volatility skew is basically the difference between IV of calls and puts. Usually we're talking about out of the money calls and out of the money puts because those have a higher implied volatility. So volatility skew on the S&P 500, for instance, you expect that out of the money puts have a higher implied volatility than out of the money calls because we tend to see drops. There's that saying that says you take the stairs on the way up and the elevator on the way down, because drops usually have a more significant move than rallies. Also, people are usually buying SPX options or SPY options in order to hedge their long positions in the index. So that is why the implied volatility of out of the money puts usually is higher than out of the money calls. However, we are starting to see that the implied volatility for calls are also going up. So right now we are at parity between the IV on calls and the IV on puts for SPX. Now, this is what you usually tend to see before drops when the skew ends up being even between calls and puts on SPX. This is why I said in my last video that I would likely hedge using VIX calls as opposed to shorting the market. And that is also something I want to address here. I'm not calling for shorting the market just yet. I'm not saying that. All I'm saying is this is a time to start taking profits. And if I am going to hedge, I'm likely going to use VIX calls. Now, I said this right before CPI, and the market dropped 1.5% on CPI. Do you remember what the VIX did on CPI just a few days ago? The VIX spiked 20% on the day of CPI, just for a 1.5% drop in the S&P 500. This is not normal. You could think of this as a squeeze play due to the amount of shorts on volatility, okay? I'm not going to get into the mechanics of vol skew. You can Google vol skew and read yourself to sleep if you want to. But this vol skew right here, we haven't seen this since February 2018, where we also did have a major correction in the stock market. But I remember the VIX went up like 40% in a day or something like that. It was crazy. But I think that some situation can happen in which the VIX actually spikes like crazy. If we get, for instance, another hot CPI print, or the Fed does a surprise hike, which personally I don't think is going to happen, or some sort of black swan event, or NVIDIA actually shits the bed, I can see a spike in the VIX. And I will likely be putting a play on the VIX once again in order to take advantage of any squeeze that we get due to the vol skew being so out of whack there. And of course, I will post this in the Academy. Once again, make sure you get on the wait list below for when we open up on the 26th. Now, the last thing I want to talk about, is there a way that the market continues going up? Of course, the market is meant to go up. It can always go up. It doesn't need a huge reason to go up. It needs more of a reason to go down. However, I think that a lot of perfect case scenarios would have to happen. So, you know, we would need NVIDIA to report great earnings, good guidance. We would need for CPI to not disappoint once again. But logically, if we're at the point where we're waiting for bad news because it shows that rate hikes are working, but it can't be that bad, because if it's that bad, then it shows that the system is cracking. So we just need it to be bad enough, but we can't have it be good data, because good data means that the Fed will have to do more. Like, we are in a very murky territory here. And if you take a look at the S&P 500 earnings yield, it is at 3.7%. This is well below the median of 6.67%. And this is usually what we see in recession territory. This is the lowest that we've been without a recession. So when you still have money market funds paying close to 5%, is it a surprise that the total money market fund assets have exceeded 6 trillion, the most ever on record? Like, if you're expecting, again, as I said before, I was rewarded handsomely for being brave enough to buy the dip on this and telling others in our group and publicly that we are buying the dip on the S&P 500. So if you are getting close to 5% on your money market, and it's basically risk-free, or, you know, if you're in treasuries, versus a 3.7% forward yield on the S&P 500 at this price, I could see why moving towards a more risk-free asset during this time, especially if you bought the dip, it makes a lot of sense. So there you have it. Taking some profit off the table, especially on riskier stocks, non-blue chip stocks, or blue chip stocks that I bought recently during this wave of the correction in the bear market. I'm obviously not going to liquidate every portfolio that I have, especially a portfolio that I've been building since, you know, 2008. So when people ask me, should I sell? Should I sell? Well, everyone's different. It really depends on what you bought, what your portfolio is, what's your time horizon, what's your time to retirement. You know, I get all these questions, but every position, every portfolio, every person, every time frame is unique. So that's my opinion. Make your own determination. Obviously, I will be hedging with VIX calls. I will be hedging with covered calls. I will be hedging with some protective puts. There's an array of things that I hold, and, you know, a variety of ways that I plan on playing this. I will post a lot of my public plays in the Discord, but hopefully you got something out of this. If you disagree, if you agree, if you have a question, leave it down below. Would love to hear from you. Would love to hear your perspective on what you think about all of this. Was some of this data new to you? Was it compelling to you? Was some of this data just like, whatever? Would love to hear from you guys. Sign up to the free mastermind March 3rd, 7 p.m. Eastern. I'm going to be going over a free trading mastermind webinar. I'm going to be hosting it live. It is not recorded. It is me doing it live. There's only 1,000 spots. We have almost 800 signups. So make sure you get your name on the list. We're going to be capping it at 1,000. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.